gold price has taken a hit, but how have miners adapted to this new environment? Is it a new environment, or is it still the same if you consider all the macroeconomic forces? Sean Boyd, CEO of Agnico Eagle, is back with us to discuss this and his plans for his company. Sean, it's a privilege speaking with you today. It's not often we have you on the show. Welcome back.
Great to be here.
Thank you very much. Let's start with updates from your company. The big news coming out of Agnico Eagle up till now in 2021 is your TMAC acquisition, which you made earlier the year. Tell us about that deal and tell us why TMAC.
Well, we like it from an exploration upside potential. There's two major trends that about 80 kilometers long. The resource and reserve is over 7 million ounces, and we expect that to continue to grow. And as a result of that, we've got about a $16 million exploration program laid out for this year. So we're going to drill a lot of targets. So by this time next year, we would expect that overall mineralized envelope to continue to grow. While we're drilling, we're going to study opportunities to expand output there. We do feel that at some point there is an expansion scenario that'll work, that'll make good sense, and we just see this as another high-quality project that we can put into an already solid project pipeline.
Okay, and can you give us an update on some of your existing projects?
Absolutely. In addition to the announcement earlier this year of Hope Bay, we also announced the go-ahead on two construction projects. One, the Amaruq Underground, which will add high quality, higher grade tonnage to our open pit operation at Amaruq. That will allow us to increase output as we move forward in Nunavut. But the biggest project and the one with the biggest potential long-term impact is the Canadian Malartic underground opportunity that we share with our partner Yamana at Canadian Malartic. As we announced, this will be, once it's up and running at full potential, it'll be Canada's largest underground gold mine. It'll be operating daily tonnage rates of around 19,000 tons a day, producing over 500,000 ounces. The nice thing as well is that it significantly increases the mine life at Canadian Malartic. So what we really like about it is not just those economics and the returns that we will get, is our study is only incorporating about half of the known mineralized envelope there. We're using 7 million ounces. The overall combined resource exceeds 14 million ounces. Those zones are wide open. So this is a significant positive event for both Agnico Eagle and Yamana, and we're going to continue to optimize that going forward as well. The exploration budget there this year is $30 million, so lots more drilling to come. We would expect that deposit to also continue to grow.
Let's bring it back now to the macroeconomic environment and talk about gold and how it relates to your environment. As you know, like I started this interview, as you know, the gold price has come down from its highs in August. Has this at all concerned you from a producer standpoint?
No, it's a long-term business. I've been at this for 36 years. We've seen a lot of ups and downs, and we were running a business without a hedge book when gold was below $300. So you can't really pay too much attention to what the gold price is going to do. What's really important is thinking long-term, setting your business up so that you're in a strong relative position to take advantage of opportunities. And so we look out at this price environment. We see an ability to continue to invest in the future. As we said, we're not only advancing key projects, we're also increasing our exploration budget by about 40%. So in 2021, we're spending $160 million. So we still see tremendous opportunity in our current portfolio. We're going to continue to do that regardless of the gold price. And so that's where our focus is. And I think generally that's where the industry's focus is looking for opportunities to improve the quality of the business and take advantage of even these gold prices are really good. The industry can still generate significant free cash flow at the current spot price of gold.
Does the spot price of gold affect your CapEx budgeting at all for your exploration?
No, it doesn't. We laid out an exploration and CapEx strategy a few years ago, working within an envelope. And that envelope allows our internal projects to compete for capital. And it was designed really to ensure that we have a significant investment in the future of the business which is important, and that's been really the basis for our successful strategy. But also while doing that, we can still provide really strong returns to our shareholders. We increased our dividend last year twice. We've paid a dividend for 38 now consecutive years. We've increased the dividend each and every year since 2015. So we've been able to create that right balance. So we'll continue to do that. The gold price is going to do what it's going to do. It's going to go up and down. We're just focused on maintaining that strong, high quality, low risk business.
Okay. Investors are wondering whether or not miners are moving away from the challenges that COVID has posed last year. How would you compare this year's operations relative to last year's in regards to the challenges posed by COVID?
Yeah, that's a great question. Last year at this time, as the pandemic was becoming apparent, all of us were dealing with tremendous uncertainty. And it was a really complex time because information was changing on a daily basis. And even during the day, we were getting different information flows. At one point, in the second quarter of last year, we had 7 of our 8 mines impacted in terms of either shutdowns or significantly reduced activities of those sites. But we're really focused on 3 things there: keeping our employees safe, making sure that where we did have activity, we were making sure our assets were strongly positioned for the second half of the year. And we had the best 6 months we've ever had in our 60-plus year history in the second half of last year. But we're also focused on COVID presented a lot of opportunities for Agnico, but also for the mining industry. Given where mining tends to operate, we're generally in much better logistical position, and we have much greater capacity to do things to help communities. So we found opportunities in Nunavut where we can really significantly contribute to those communities. We took some significant steps about a year ago where we had all of our Inuit workforce go home. We didn't want to run the risk of having the virus move from the mine potentially into the communities. That would have been devastating. Those workers are still at home because the conditions just aren't right to have them back. But vaccines are in Nunavut. The residents of Nunavut are getting vaccinated. We think conditions will improve to be able to get them back to work. We want them back. They're a big part of our business. But we've also done things where at one point we were providing food hampers to over 2,000 families. So there's a lot of things that we've been able to demonstrate why mining should be considered an essential business because of the contributions that are made, positive contributions that are made each and every day. And that was certainly demonstrated through COVID.
Let's talk about operating strategy. Can you give us your 5-year plan?
Well, the 5-year plan is really the 10 or 15-year plan. I think that's why we've been successful in creating a lot of per share value over time. Keep the share count down, keep the risk level manageable, but take geological risk. We've really built this company on the back of successful exploration success. We've made significant discoveries. It's been bolstered by an M&A strategy that's designed to go early. So we get all of that geological upside, and Hope Bay is no different than that. We've really built this company from a single asset company in the late 90s that only had 50 million in revenue to the company it is today through exploration and early stage acquisition. So there's no change in that strategy because it's successful and it's well matched to our skills. So the focus will be on optimizing the existing asset base. And as we said, we're getting good exploration results at LaRonde, at Goldex, at Meliadine, at Kittilä, at Canadian Malartic, Santa Cruz in Mexico. Work those brownfields opportunities as well as working the project pipeline at a very steady and measured pace so that we keep the risk level low in terms of execution and technical risk, but also financial risk, and do it in a way where we can continue to generate meaningful free cash flow and continue to move dividends to our shareholders.
I'm taking a look at your costs now. Your all-in sustaining cost for some of the properties is around $900 to $1,000. Is that correct? And
that's correct.
I wonder how this ranks against your peers. I notice it's slightly lower than some of your peers of your size. And I wonder, and I like to ask you about cost control and how is it that you've managed to maintain competitive costs? What is your strategy around that?
Well, costs will vary by jurisdiction, but the biggest driver of costs is the underlying quality of the ore bodies in terms of the grade and the grade content. So we find ourselves having an average grade that's well above the North American peers. And as we move forward and open up our new projects and the new areas within our mines, our grade profile goes up. And that's the biggest driver in terms of managing unit costs. So none of it can be challenging. It's a bit of a higher cost jurisdiction, so we have to stay focused on managing the cost. But I think the cost question is one we get all the time, and the industry gets all the time. And it's really from the perspective of, okay, this time around versus 12 or 13 years ago, in a good gold price environment, can you deliver the margins? Can you keep the lid on unit costs? And we would argue that the industry is really well positioned this time versus 12 or 13 years ago for two reasons. One, we don't see as an industry the type of input price pressure we saw 12 or 13 years ago. But I think more importantly, and you mentioned, David, about a 5-year plan. Well, the next 5 years for all companies in this industry, in terms of production or costs, are delivered off of the reserve base. And the reserves for the industry have been calculated at $1,200, $1,250 for the last 7 or 8 years. So these are high quality reserves calculated conservatively. We're not seeing significant dilution in the underlying quality of the reserve base that drives the industry, like we saw 12 or 13 years ago, where the reserve price assumption was going up each and every year, which was really diluting the business. So the industry is well positioned, and that gives the industry a great opportunity to deliver the free cash flow and deliver that margin that investors are looking for.
Yeah, I've spoken to some economists about the outlook on the economy, and one of the concerns people have is rising inflation in the wake of unprecedented debt levels from the government. Are you concerned about inflation on the front of raw materials, energy costs, wages? Would that affect your all-in sustaining costs? Have you factored that into your guidance?
Yeah, well, as we said, we're not seeing the type of pressure we saw on inputs like 12 or 13 years ago, where we were getting letters from suppliers in the second quarter of the year already having agreed on the price of key inputs for the balance of the year, looking for 20 to 30% increases. So it's nowhere near that. I think there is inflation coming. That's certainly going to be negative in a way on cost, but also positive, we think, on the overall gold price. And so we're a natural hedge in terms of an industry to deal with that inflation. So as we said, I think we've got to keep an eye on it, but we're not in the position where we were as an industry 12 or 13 years ago, where we saw tremendous price pressure.
Okay, financing now. Can you talk about how you financed the TMAC acquisition, and just more broadly speaking, whether or not low interest rates right now are conducive to raising debt, or would you prefer to raise equity, or neither of those options?
Well, we paid cash for TMAC, and so we didn't want to dilute. So we see a tremendous upside in that asset in terms of overall reserve, resource, and then production. For us, after 60 years, we only have 245 million shares outstanding. So it's all about per share value. How do we increase our owners' exposure to production per share, to reserves per share? So we're in a position to use cash. We see each and every quarter our net debt levels will come down. We're generating free cash flow, as we said, and still investing in the future. But I think what we've done successfully over 60 years, we're still here. And I've seen over my 36 years, many of our peers disappear because they took largely, in most cases, too much financial risk. So we're very mindful. I'm an accountant, so I watch that carefully. We're very mindful of ensuring that we have significant financial flexibility to continue to invest in the future, not increase the overall risk profile of the business. In terms of interest rates, I think that's one of the headwinds for gold at the moment. In addition to a high stock market and a high US dollar, as interest rates are moving up, those are three headwinds at the same time. You can argue that gold's actually done pretty well in the face of those three headwinds. And so I just think we're in a position where, as an industry, you stay focused, you stay disciplined, you focus on adding ounces through exploration and building out your pipeline. And I think the gold price is going to look after itself and be fine.
Do you think those headwinds are likely to stay in the market for a considerable amount of time, Sean?
It's hard to say, but I think that, the stock market's been going up for a number of years. I think interest rates, given the debt levels, and you referred to them, David, I think you need to step back. And I think the conditions that got gold to 1,700 prior to the pandemic are still very much in play, where debt levels continue to rise, economies can't keep pace in terms of the rate of economies to the rate of growth of debt. And it's really about hard assets versus paper assets at the end of the day. And hard assets will win that. And it just may take some time. So I think that's why companies just need to stay focused on keeping their businesses high quality, low risk, and take advantage of opportunities to just improve the quality of the underlying business.
I'm wondering, for a miner, do you consider monetary policy or the direction of interest rates as a consideration for changing the capital structure of your firm? So the percentage of debt versus equity on your books?
Yeah, not really. I think we look at it, we're investment grade, and that's really the key parameter we always look at. Back in 2014, when we partnered with Humana to acquire Osisko, we had to write a $500 million check in addition to issuing stock. But we quickly made sure the following 2 years after writing that check, we made sure we reduced our credit lines, which we drew on there. So it's always about managing financial risk, and you never want to put yourself in a position where you have too much debt. Our net debt to EBITDA is dropping. We're in a strong financial position. We're risk averse when it comes to debt and debt levels.
Okay. And finally, I'd like to talk about, two things. Your outlook on the mergers landscape. We talked about TMAC, and I'd like to get sort of your outlook on whether or not more M&A activity is expected in the mining sector, given where the gold price is currently and given sentiment in the gold market. First of all, do you usually see more deals done at a lower gold environment or a higher gold price environment?
I think generally higher. I think the experience has been in all the resource spaces when you tend to get commodities pricing move, whether it's oil or gas or gold or base metals, you tend to get more consolidation. I think from a gold industry perspective, it's pretty fractured in terms of ownership relative to something like base metal. So there's far too many players relative to the number of high quality opportunities that exist out there. We've been saying that for years. So the industry actually needs smart consolidation so that assets end up getting into stronger hands because the business isn't getting any easier. It's getting much more complex. As we like to say, mining's tough enough, so you got to keep the risk levels low and focus on the basics. So I think you'll likely see more consolidation. And I think for the most part, it'll be disciplined where you're, combining things and that actually strengthen and end up with a better business overall. So that's what we look for going forward. I don't think you're going to see rampant consolidation, but I think there'll be more as we move out over the next 1 to 2 years.
And what about the technological innovation experienced by the sector? Investors have pointed out that the oil sector, for example, has seen many phases of technological innovation. They've had the fracking moment. Where is mining? Where is the gold mining's fracking moment? And why have we not seen tremendous progress in the drill bit?
Yeah, that's a great question. I don't see, and the industry doesn't see, this fracking moment where the whole industry is turned upside down because of some innovative breakthrough. I think people point to the last time this happened would have been heap leach technology, where the industry took very low-grade deposits and turned them into important parts of the business. I think these are sort of moderate steps that we'll see from an industry perspective. Things like using more automated equipment. That's a safer way to go, more cost-effective way to go. There's still a bit more to do from the technological perspective, particularly in underground context when you've got multiple pieces of moving equipment.
Let me put it to you this way, Sean. If a tech company were to approach you and say, "Hey, Sean, I have technology at my disposal. I could build you whatever you want. List me the dream technology that you would need, that you would want to have at your disposal. Let's say it's Christmas, it's coming up. What would you want to have that could significantly bring down your all-in sustaining costs and perhaps even significantly increase production at a much faster pace and perhaps even make exploration much easier? What would you like to see?
That's a big wish list, but I think the trend in the industry has been declining grades. And so we're basically fighting nature, where a lot of the easy deposits have been found. And so that's the challenge over the next 10 to 15 years to not only grow, but grow in a way where you're actually adding quality to your business. So anything that could improve our ability to recover gold from low-grade deposits. We're working on technology around ore sorting so that we could take lower grade deposits and make them a higher return project. So it's really what technology will allow us to take lower grade deposits as an industry and turn them into significant businesses. And that's what happened back with heap leaching technology, where there was a lot of material in Nevada which just didn't work to put it through a conventional mill. But heap leach technology basically turn that into an extremely successful business. And look at the two big companies in our industry, Barrick and Newmont, have a strong base in Nevada. So ability to improve recoveries and extract gold, low-grade deposits could be a potential game changer.
Sean, I want to thank you so much for coming on Kitco today and giving us your update on both the economy and your company. Thank you very much.
Great. Thanks, David. Nice to be here.
And thank you for watching Kitco News. Stay tuned for more coverage. I'm David Lin.